You know, you'll often hear investors say, I don't want to buy penny stocks because they're too risky, or I'm going to avoid biotech stocks because they have too much risk. Well, is that the right way to think about it? And really, what is risk? That's what I'm going to explain in this week's video. And then, of course, I'll do my normal market analysis. We'll figure out where the market is likely to go in the next little while. Plus, I'll look at the trade of the week on a stock SOUN, which has been a past stock that I featured here. We'll talk about how that stock moved and where the entry and exit points were. But let's dive into this risk discussion first. So typically we think of lower price stocks as risky or smaller cap stocks as risky. But I want you to think about it in a little different way. You see, investors often confuse price volatility with risk. Some stocks move up and down a lot more, but that doesn't really make them riskier. That just means that they're more volatile. Risk is really defined by the potential loss on an investment or on a trade. So if you buy too much of a volatile stock, you're really taking on more risk, and I'll show you in a moment what I mean by that. If you buy less of a volatile stock, you are effectively controlling risk. Really what it comes down to is the investor drives the risk. It's the investor or the trader that is risky. So here's an example of a stock that I featured in my weekly newsletter, and I'll quickly show you. This is a free weekly newsletter that I send out. I pick stocks in it. Let's just jump to the Stockscores website. And if you look here, on a couple of occasions, I featured SOUN there and there. That was October 13th and October 27th. And if you want to receive this newsletter for free, there's no obligation. I just send it out every week. Just go to the Stockscores.com website, go to the home page, scroll down a little bit here where it says start your free Stockscores membership and your free weekly newsletter. Just click on that and put in your email address. We don't like spam. I hate spam, so you're not going to get a bunch of garbage from us. But let's continue on with what we're looking at with this stock. So one of the entry points on this stock right here was there. It traded abnormal volume, had an abnormal price jump, and you can see that the stock score indicators were above 60 for the green line and above 80 for the blue line, which are two of the rules that I like to use when I'm looking for position trades. Now what's important is that the entry price on that day was about $6. We'll round it down just a little bit, $6. And the stop loss point, which is the low, the little floor price there before the stock started to go up, was about $5. That meant that you had $1 a share in risk. Now the typical investor thinks, how much of a stock can I afford to buy? If they have $6,000 in their account, they might buy 1,000 shares of this stock. But what I want you to do instead is think about how much can you afford to lose? How much are you comfortable losing? And that then determines your position size. So if you're buying a stock at $6 and you're going to put your stop loss at $5, that means you have $1 a share in risk. If you're comfortable losing $200 on any one trade, then you would buy 200 shares, not a full 1,000 shares, simply because that's how much capital you have. So what you can end up doing then is make every stock have the same amount of risk. You simply look at the difference between your entry price and your stop loss price and divide that into your risk tolerance. So in our example here, our risk tolerance is $200. You're willing to lose $200, you buy 200 shares. You're willing to lose $2,000, you buy 2,000 shares. That's what determines the riskiness of the stock. And in doing so, you can make every stock have the same amount of risk. Let's look at another example here. This is another stock that I featured in the newsletter, and this one is much less volatile in percentage terms. It's a bank, Bank of Hawaii. And so you can see here the entry price was right about $72 and our stop loss price was $64. Now that meant that this stock had $8 a share in risk. And so in this case, if you're willing to lose $200, well, $8 into 200 is what, 50 shares? So you would buy 50 shares, no, not 50 shares, 25 shares. 25 shares times $8 a share in risk is $200. I hope I'm doing that math right. I'm doing it on the spot here. So 25 shares of a $72 stock is a much smaller amount of shares, obviously, but it has the same amount of risk as our last trade. And it's simply because we adjust the position size to reflect the difference between the entry price and the stop loss price. And if you do that, you're going to be much more successful in the market because you are making every stock have the same amount of risk. The more volatile stocks, which formerly you might have thought of as risky, but now we're just calling them volatile, you just take a smaller position in them. And those small price stocks, they also have the potential to make much more significant gains. And what you're doing then is you can really get more bang for your buck from those low price stocks. Now, a couple of other elements of risk that we need to think about. One is that liquidity is another aspect of risk. A stock that doesn't trade very actively, in other words, it doesn't have as many shares trading each day, has an added element of risk because the slippage on your trades could be much greater. You may say, well, if it falls to $5, I'm going to get stopped out. But if a stock is less liquid, less actively traded, then where you might want to sell it at $5, you may not get out until $4.80. So that is one thing to think about. Liquidity has an element of risk. And there's also the potential for price gaps. Now, stocks that are coming into major news announcements have the potential to make a big price gap, up or down. In other words, one day they could be trading at $10. Let's say they release poor earnings, they could open the next day at $8. It doesn't matter if your stop loss is at $9, you're not going to be able to sell it until $8. And so that's another element of risk that you want to think about. Companies that have big news events coming up, sometimes with biotech stocks, they could have a decision on a drug approval from the FDA. That could really cause a huge gap up or down. It could make a big jump up if they get approved or a big jump down if they don't. All right, well, let's get into this week's market analysis. We've got pretty good markets right now, and I think we want to think about whether the market is more likely to go higher than lower. So let's start with a chart of the S&P 500. SPY is the symbol. Daily chart here, you can see that the trend is up. Volumes were pretty low last week. If we go to the 1 month chart, we see that the trend is up, so that's bullish. 3-year weekly chart, trend is up, so that's bullish. And so there's no reason to not be in the market right now. Even though you might say, well, it's gone up so much and therefore there's that risk that we're going to see a correction, there's no sign of a correction here. Corrections don't happen overnight unless there was some extremely abnormal event. Typically, you break the upward trend line, you build a falling top, and then you start to go into a correction. We're not seeing that on the S&P 500. How about the NASDAQ? QQQ is the symbol. And there you can see trend is up on the daily chart, the 1 month chart, and the 3-year chart. So we're bullish on all time frames. IWM, the small cap stocks in the US. 1 month chart, there you can see a little bit of a pullback the last week and a half or so. And it was certainly a little quieter for those small cap stocks. However, if we look at the 3-year weekly chart, we still see that the trend is up. Now we are running away from the trend line. And so there's some potential then for a little pullback to the trend line, but that's okay, that's normal, and we shouldn't be too worried about that. How about the Canadian market? T.XIU is the symbol, and there you can see trend is up on the daily, on the 3-year, all good. Let's take a look at gold, which has had a great run this year, but is now starting to break down. We had this parabolic move to the upside. We broke that parabolic trend. That's step 1 in a reversal. And now we're building a falling top. And so if we were to fall down through this floor from a falling top, that would be a signal that the bull market in gold is ending. Let's take a look at the 3-year weekly chart. You can see that we're still okay because we're still holding the upward trend lines, but we're right at it. And so we should be a little bit cautious, not necessarily a run and hide type sell signal, but just one warranting some caution. USO for oil. And you can see that the general bias is to the downside. We've got pretty strong support here. It shows up even more on the 3-year chart. We've been stuck in the sideways range, but there is a little bit of a downward bias there, and that's why that sentiment stock score is 31, meaning generally speaking, you kind of want to avoid the oil sector. It's just not really in an upward trend while the rest of the market is. And so until that cycle of falling tops is broken, I want you to, generally stay clear of the sector. On the US dollar, trend is up. A little bit of a pullback the last few days as the market is now starting to think about the potential for interest rate cuts in the US. If we go to Bitcoin, one of the hot markets right now, GBTC, of course, Bitcoin went over $100,000 this past week. If we look at the short-term chart, trend is up. 3-year chart, trend is up. So we are bullish on both time frames there. And then finally, TLT is the chart of the bond market. And you can see that 2 weeks ago, we broke the downward trend. We're starting to move up. That means interest rates are starting to move down. That is bullish for the market, and we'll see if that continues. All right, so let's jump into my ratings then. I am bullish on both time frames for US large cap and NASDAQ, only neutral in the short term for the small cap stocks in the US. Canadian bullish on both time frames. Gold, short term neutral, a little bit of a sign of weakness coming in, but still long term bullish. Oil, I'm neutral, but it's almost bearish. We just need to see that breakdown through support to go bearish on oil. US dollar neutral short term, bullish long term. Bitcoin bullish on both time frames, and bond market starting to be bullish in the short term, but neutral in the long term. All right, now it's time for the trade of the week, and we're going to go back to that stock SOUN, because just like it had a buy signal back in October, which I featured in that weekly newsletter at Stockscores.com, there has also been some good swing trade signals, which I use my action candle indicator to identify. So I've got this indicator called the Stockscores action candle, and you can see it here on the chart. It's anywhere you see a pink and yellow dot. So you can see a few of them. Obviously there's a few on here, a bunch over there. And what we look for are action candles that surprise the market. So here you've got the market kind of going lower, and then there's a surprise showing of strength right there. An action candle has abnormal strength and abnormal volume, and this on the 13-minute time frame. So that was buy signal number 1 back on November 29th at around $8, a little over $8. And then we had another one earlier this week right there at about $10. And in this case, let's think about risk management. Let's use this most recent entry signal. So our entry there, let's call it $10, and support here at $8.50. That meant that your risk per share was $1.50. So if you buy 100 shares, then your risk is $150. If you're comfortable with $150 of risk, then you buy 100 shares. If you're comfortable with $1,500 of risk, then you buy 1,000 shares. And this is how you can make every stock have the same amount of risk. And in this case, this stock did a nice little run. It still looks like it can go higher. It's now at $15. And so it's picked up $5 a share on a trade where you had $1.50 a share in risk. So it's a little better than 3 times its risk. That's a nice trade. Always think of performance in reward for risk. How much reward are you getting for the risk that you take? Well, hope you've enjoyed this week's video. If so, please click the like button. Make sure you're subscribed to the channel, and most importantly, trade well.